Good evening, everyone. Today I would like to give a short and very brief overview of what a Section 25 company is versus a non-banking finance company. And so, by default, it would define that you would be looking at more of financial activities and how the two entities are different, why they will be opted, why they may not be opted, and what action or which of the two would be a better option for any organization or any financial entity to adopt. So, we keep hearing the word Section 25, NBFC, private company, corporate body, a lot, very often. So first let's go through what these entities are, what laws and what acts govern them, and then we should probably move on to how practically one has certain advantages and disadvantages, and owing to these advantages and disadvantages, each can be adopted. So first a brief intro of what kind of entities are defined in that. You have director, sole proprietor, partnership, corporate body, Section 25, NBFC. So NBFC would come under companies or corporate body. Even your foreign companies would come under that. And you have trust, cooperative society. These are a general intro to what kind of entity. And of these, you would be looking at Section 25 company in terms of microfinance and financing, and NBFC and the company in terms of financing. So, what is a Section 25 company? It's actually a not-for-profit company, private company which is for a charitable purpose, and owing to its purpose, provided with several privileges by the regional director of the Ministry of Public Affairs. So, the predominant or the key identifiers to a Section 25 company is that it's generally for a non-commercial purpose, it's charitable or for promoting a particular activity, which can be scientific, which can be sports, which can be financing. Secondly, profit of a Section 25 company, and this is the key reason why they get benefits, is not distributed. It's always plowed back and used for development of that particular field. So, finally, Section 25 companies are defined by their license, which is issued under Section 25 of the Companies Act, which is by the name, by the regional director. So, we have 4 regional directors, North, South, East and West, Chennai, Kolkata, Mumbai and Kanpur, where the regional directors is, and they take care of each of the zones and issue the Section 25 licenses, certificate of license. Few more info or inputs on Section 25 company is that the advantages a Section 25 company has is extremely vast in both Companies Act and RBI Act. So, Companies Act gives privileges like they don't have to mention the word private limited in their name. So, the general public sees it as an institution which is for promotion, not for profit. Besides that, they also have a lot of advantages like they don't need the minimum capital, they don't have to maintain an asset size, they can appoint any number of directors, they can have any number of members, any people as members, they can even have partnerships and sole proprietorships as members to the company, which is generally not permitted in a private limited company or a for-profit company. In addition to these advantages, there are also the big limitations, which is that they can't distribute the profit, which means there is no restriction on the investment of equity. There need not be equity at all, because equity's purpose is that profit from an earlier dividend. So, a Section 25 company's privilege is that it need not have any minimum paid-up capital or equity, but at the same time, it's a restriction because you need to ensure that profits are not distributed. Now, a non-banking finance company, the key identifier would be that it is generally defined under the RBI Act 1934 to be any activity of financing investment or dealing in shares or equity, hire purchase, asset purchase, which is more or less around insurance, all around financial activity. It's governed by the Reserve Bank of India, which issues a certificate of registration identifying that particular company as an NBFC, and it has all activities of a non-banking finance institution, which is clearly defined by the Reserve Bank of India. Very strict vigilance, governance. There is constant review by the Reserve Bank of India. Annual, quarterly, monthly documents that have to be submitted. So, it's the exact opposite end of the Section 25 company in terms of what all compliances are applicable to it. And in addition, it is a private company. So, all compliances with respect to a private company, or if it is incorporated as a public company would also apply, in addition to whatever RBI Act. Now, as I had briefed earlier, not-for-profit is governed by the Companies Act, particularly Section 25 of the Companies Act, which says that the company need not have name, may not and should not distribute its profit. But in terms of RBI guidelines also, Section 25 companies are given a huge privilege because Section 25 companies, if they are involved in microfinance and if they restrict their lending up to 50,000 per individual and 1,25,000 for a housing or dwelling unit, would be exempt from the requirement of the certificate of registration. And every other compliance follows the certificate of registration. Hence, the RBI actually gives a huge benefit to Section 25 companies when compared to NBFC. For the one reason that they don't distribute the profit. They plug it back for the advantage or the benefit of the society. So, in terms of procedure for incorporation of a Section 25 company, it's a little more tedious than private company. So, predominantly, private company and Section 25 have the same basic procedure. The only addition is that, and the most important addition rather, is that the regional director needs to give the certificate of license, identifying it as a Section 25, for which the regional director takes the in-depth scrutiny of the memorandum and articles of association. Now, the memorandum and articles are the bylaws and the charter documents. They define what the company can do and how the company can do it. And in order to ensure that this memorandum and articles is in line with what the company proposes to carry out in terms of its charitable activity or in terms of the activity which is benefiting the society, the RD generally reviews it and ensures that no provision in the memorandum or article mention about distribution of dividends or utilization of profits for anything other than the benefit of the society or the purpose for which it is created. And generally, it gives a lot of comments out. Once all the comments are implemented, the forms are marked in file. The registrar companies, who generally take care of all private companies, approves the form. After which it goes again to the regional director who has already reviewed all the documents, who then issues the certificate. Now, NBFCs, as I said earlier, was governed by Reserve Bank of India. NBFC generally take their definition from the RBI Act 1934. Section 45I is the predominant section which caters to all definitions. And RBI defines NBFC by first defining a non-banking financial institution which covers companies, corporate bodies and cooperative societies. It's sort of all-encompassing. So, which is how any company which caters to financial activity by the definition of NBFI fall under RBI guidelines. So, a company which is not a Section 25 company, if it wants to do financial activity, should register with RBI by virtue of this definition. So, the definition is a bit detailed. As you can see, it covers all kinds of financial activity: lending, chit funds, insurance, broking. Once an entity comes under NBFI, if it is a company or a corporate body or a cooperative society, it becomes an NBFC. So 45IA is the defining section for the certificate of registration, and any company which is an NBFC should fall under RBI if it's not a Section 25 company, and should have its certificate of registration for commencing business. Now, in order to have the certificate of registration from RBI, most important conditions that the RBI defines is that the net worth fund of that particular company needs to be above 25 lakhs, and if it's incorporated after 2002, it should be above 2 crores. Also, the nature of business is extremely important. The principal business is defined as if the financial assets are more than 50% of the total assets, and income from financial assets are more than 50% of the total income. So these two are the defining key definitions of a company to be an NBFC. And this definition would last for the entire life of the company. It's not only at the time of incorporation. These two factors are during the life at all times. Now, in terms of incorporation of an NBFC, it's very similar to a private company in terms of what needs to be filed with the ROC. But RBI, unlike the regional director, not only reviews the document but also requires a huge set of additional information. This can be additional information on the management, the director, the past financials, the business plan. If it is incorporation, past financials won't be there, but business plan. So it's a 16-page condensed document of a list of requirements, and each of those requirements may be about 10 to 20 pages. So after scrutiny of all these documents, RBI would issue the certificate of registration. So the process goes like first, RBI needs to approve the name. Then we come to the ROC filing for the requisite forms to pertain them to adopt the name. After which we create a charter document, get the company incorporated. But the business of the company cannot start until we actually get the certificate of registration from RBI, for which the detailed document has to be provided. So now we've seen what is a Section 25 company and what is an NBFC, and how Section 25 company and an NBFC have to be incorporated. So the broad areas of difference is in the fact that a non-banking finance company is much more stringent. It's under constant review and vigilant governance by the RBI when comparison to a Section 25 company. And the reason for this primarily is the fact that Section 25 companies cannot distribute dividends, and there are additional restrictions of how we can't give beyond a specific amount to an individual or a dwelling unit. So, the key differences between NBFC and Section 25, what defines each of it. So, as I said, the biggest advantage is not only limited to this, would probably be the broad advantages of the Section 25 company. But in addition to RBI not governing or not requiring for constant documentation or filing or compliance with specific sections in terms of the minimum net worth fund or asset size, constitution of company, the Companies Act itself has several advantages for a Section 25 company in terms of the director, interested parties contract, who can be members, etc. So, regulatory compliance for a Section 25 company is extremely simple, and the Section 45IA is with respect to the certificate of registration for NBFC, which is not applicable for the Section 25 company. However, Section 25 company, owing to the fact that they can't distribute dividends, they can't distribute profits, and they can't lend beyond a particular point. So on both sides, with respect to receiving equity or funds and with respect to lending or providing loans or providing services, financial services beyond a particular limit, Section 25 is clearly restricted. So that's the biggest advantage that an NBFC has. And of course, although we say that NBFC has a constant scrutiny and strict governance principles, it makes an NBFC much more efficient. By virtue of complying with all the requirements of a private company and the RBI Act, an NBFC always has the necessary documents. It always ensures that with respect to the number of directors, with respect to the net owned funds, with respect to utilization of its funds, is always in compliance, and that also helps the business of the NBFC. We come to actually the last bit of the comparison. Given that the incorporation and provisions governing a Section 25 company is simple, and the fact that an NBFC is well governed, is well regulated, and can also distribute profits, leading both in terms of inflow of funds as well as lending, NBFC has a much wider scope. All differences are broadly governed around those areas. So while the advantages for a not-for-profit company is that it does not need registration with RBI and hence no particular registration, especially no requirement for net owned funds. The advantages for an NBFC is the nature of activity. In fact, RBI actually provides the advantage to NBFCs to carry out certain activities which neither Section 25 nor banks can carry out. NBFCs have actually a good amount of privilege also in terms of what they can do. So, line of activity is clearly an advantage for NBFCs when compared to not-for-profit. And by line of activity is also encompass the extent of that line. So not only is there no limit on the nature, it can do anything beyond microfinance, it can also do anything in the middle. Finally, the biggest difference is that NBFC is permitted to distribute dividend profits, whereas Section 25 companies.
What's the point in them plowing it back into the business?
So, Section 25 company is incorporated to the objective for developing a particular objective. So, it can either be cultural, scientific, or financial, which means that the entity's core purpose is development of that particular line. So once the company is for developing the particular area or line of business, it can't do anything else. So a private company, all that in them has ultimate advantage to shareholders to the extent of the dividends. So there is that profit motive. But the Section 25 company is incorporated itself only to develop that particular field. It's for the benefit of the society. And when we say benefit of society, so salaries, etc. can be paid. Because the Section 25 company, it has to employ people, it has to spend on assets, it has to spend on revenue expenses. All that is permitted. It's just that the individuals who set up the company or promoters do not intend to get that money, get dividends by setting up.
So profits and all they can't take. That has to go back.
Clearly for the... So that is the main reason why they get so many privileges also.
No, the very idea that Section 25, that there is no profit is served back in the sense they can make profit, otherwise they are not in existence.
That's it.
Only thing is that cannot be distributed to the other person. Because in as much as they have been trying to go by ordinary microfinance sector, they can lend. Further, unless they got certain capital and also borrowings. The borrowings aspect I want to clarify on this. Because in as much as they cannot distribute the profit, there are no issues. In as much as they can do the business, okay, there are certain businesses they are permitted to do. In as much as they can do all the microfinance thing, they have to borrow only from the financial institution or banks. So, what should be the quantum for that? Okay, and only that aspect I wanted to cover.
So, in terms of borrowing, Section 25 companies can borrow up to any limit, there is no restriction. And in fact, Section 292, which is applicable for private companies in terms of having a board meeting for delegating borrowing power, is not applicable for Section 25 companies. Which means you are absolutely right. The mere fact that RBI states that microfinance can be done by a Section 25 company means that they can borrow, and with the borrowers they can lend, and they can also earn an interest on that. But the interest earned should be more for development of, or rather in general good of the society. So whatever income that comes has to be utilized back for the benefit. It can't come out as dividend for the promoters or shareholders. So in terms of borrowing, there is no restriction. Section 25 companies can borrow up to any limit for a person, and they also have additional privileges from Companies Act that they don't have to pass a board meeting. They can do it for governance purposes, but as far as the act is concerned, they don't have to pass a board meeting.
Can it be a subsidiary company of or holding company of other Section 25 companies or
so a Section 25 company can be a subsidiary, but Section 25 company cannot hold another company because that would deem to be investment. So again, income that comes from investment needs to be plowed back. So very, very clear. The only purpose for a Section 25 company being good of the society, they can't invest.
Now is there as stipulated the Companies Act as line of activity. What are all the line of activities this Section 25 can take? What type of activities? So promoting purposes, promoting activities. It cannot be like a manufacturing economy. No trading. No trade. Only promotional. But how about financial? If it is a promotional aspect. So do they have to ensure that microfinance loans, whatever they are going to avail from RBI, to what extent they have to ensure that it is getting promoted by the end user?
So two things. One thing is promotional activity, promotion of science, art, commerce, sports, and other promotions. Now the other business category, anything that is involved in the good of the society. So we definitely need to ensure that by providing loans, we are creating good for the society. So say the money lender who charges 35 or 40% interest rate by lending to people who don't have enough funds or don't have scope to borrow from others, it's clearly not for the benefit of the society. So as far as Section 25 company is concerned, it will not fall under the categories of development of sports, science or art, but it will be under any other category, which is development of society.
Yeah. Thanks.
So, after clearly seeing what a Section 25 company is and what an NBFC is, and what are the advantages and limitations in both of the entities, to choose between NBFC and Section 25 would clearly be in the nature of the business or the nature of growth of the particular business of lending or microfinance. For example, any startup entity which probably does not have much funds, which is clearly only providing micro funds to the society, micro lending, can clearly fall under Section 25 if it does not intend to grow back. But as a company grows, as it gains maturity, not only does it require more funds in terms of equity also, but it also needs to plow back profits. So that on the one hand, profits give a good market picture in terms of availing these debt or equity, and on the other hand, good investments in terms of equity. So as a company grows for its fund requirements, NBFC would be a better option. So perhaps one of the options would be to start a Section 25 company, and by the time it reaches a stage of maturity to start incorporation of the NBFC. Because incorporation of NBFC clearly takes more than 2 years. So by the time the Section 25 company reaches a mature stage, the NBFC would be incorporated and ready to take over. But another option would be rather to have retain it as Section 25 if that was the objective, or have the NBFC incorporated and carry on business through that. It's clearly left to the management and what exactly they are creating that entity for. Knowing the advantages and disadvantages, it's better to have a good scrutiny of both the nature of entities and then adopt whichever. But of late, one style that's being adopted or that started in a lot of entities is the hybrid structure. So where a particular company has both Section 25, private company, NBFC all under one umbrella, so that they get the benefit of all of these entities to do their business. This works more with companies that are extremely huge and that have such a varied level of business that one structure or one entity alone will not be enough to cater to its various needs as well as its requirements. The only thing with the hybrid structure is that the entity needs to ensure that there is no commingling of funds, that the governance of all these entities are clearly demarcated and going beyond not even having common employees or common assets, so that the regulatory authorities and the entities themselves are very comfortable with the fact that they are separate legal entities doing only their life. Also, the governance of hybrid structures may be...
So one question to interrupt you. This hybrid structure, now you said the Section 25 people, there's no restriction on the number of directors and things like that. Obviously the other two have. Now a director in, say, an NBFC, can he be also a director in the Section 25 as well as in the other company? He can?
So, as far as the Section 25 perspective is concerned, there would be no problem. But for the NBFC perspective and the private company perspective, you have to comply with specific sections.
Correct. So he can't be in all three.
He can't. It's advisable that he not. But common directors get affected only when there are common activities. When there is a particular activity or a transaction between the entities, in that particular situation, not having common directors is not relevant.
In those cases, there could be common directors. Is it restricted? No. So they can have common directors in all that, NBFC, only when any activity is taken in one company, where the common director has any interest in that, that has to be disclosed.
That's what she said.
So that they will not form in the quorum. Otherwise, they can attend to the business.
Disclosed and if the bigger capital of the NBFC and private companies more than 1 crore, then you have to go for central government approval. That is the only limitation. So that's it with respect to choosing the right entity or having a hybrid structure. It's more to do with the purpose for which the business is created or the evolution of business. But using these facts, it's very necessary that the management takes an optimal decision. So it's completely up to the management based on the various advantages, limitations and each of their business to decide which of these two options can be used.
Any further question?
Only one question. Go to the previous question. Not that for the sake of I wanted to clarify my doubt. Please for that. The last penultimate paragraph. Recently I read the version NBFC. Can you elaborate? I didn't catch what this is. Recently I read the version of NBFC, private company and the Section 25 companies were brought under a single umbrella. So what exactly?
For example, L&T Finance. Last one is to hold L&T Finance, which holds various companies. So some of them are private, some of them are NBFC. Similarly, if you take, they have private and so having one company to hold various entities which are specified NBFC or private is actually picking up to get the advantages of all these and also to ensure compliance with their respective activities. So that, of course, probably started only in the last couple of years, and there is still a lot of debate related to how the clear-cut functioning of the holding entity or each of these entities need to be governed. Whether we need a separate statute for them or whether it's comfortable that we have separate statute governing each of these. Those are still open questions. But right now, the nature in which they are functioning is that each of those entities are governed by their respective statutes. Which is why commingling of any of the resources is better not at all.
What exactly will be the constitution of the NBFC? I'm talking about just a private company and like a private company. What will be the constitution of NBFC, non-banking financial company? What will be the constitution?
So it's a private company or a public company.
So that means that is also a NBFC, private or public? Sorry.
This is a certificate of registration. So they do have separate regulations, they do have conditions to comply with, but under banking regulation they can't. Whereas NBFC is just
That is the higher purchase, no? Not leasing, actually leasing will not be. Hybrid.
So one, if a company, if someone wants to start say microfinance and goes ahead with section 25, obviously because of lack of capital say, and say after 2 years the business has grown to a level, and now wants to get the advantage of anything, to get more capital, private capital, and to grow. So obviously for the last few years say, it has availed the benefits of doing the section 25. Now it wants to convert. Now if I pay back, say the tax exemptions I have got, can conversions sort of thing be done?
Conversion can be done, but again, so the section 25 company needs to first convert into a private company and then convert into an NBFC. So by converting to a private company, there will be federal steps. Any amount that can be in terms of reserves or capital or profit would have to be given to another section 25 company which is in the same line. So that it ensures the purpose for which that had been taken is at least to the extent of at that point of time.
Which means, I mean, the reserves and surplus, the section 25 has accumulated over a period before conversion, can't get into the.
So this is like that. Typically, section 25 companies don't have a paper. So there will not be much to actually, and even their rate of interest or their mode of income would have been very minimal with the survival. There wouldn't be much of reserve or surplus, so to say. So, but yeah, in terms of process, it's very tedious. So after they convert to a private company, then they will have to go to RBI, give detailed reasons. Again, RBI would ask for about 10 to 12 areas of documentation and future plans, how the company proposes to carry on or go forward. And if satisfied, RBI would. So in the case of both incorporation or existing NBFC or conversion, it's completely governed by RBI. Which means RBI has complete rights to even cancel or restrict. So, to the satisfaction of RBI, once it's provided, it should probably take 2 to 5 years.
In this case, when they are allowed to plow back the profit, the president can make profit. Those profit, whatever they have earned, it has got to be plowed back into the business. But what are the restrictions in plowing back the profit? There will be internal cash accrual. And there should be any restrictions in plowing back, because they can go in and appear as some asset, or they want to improve their infrastructure in such a way that their customers, they want to enlarge the base of the customers. Is there any restrictions in that? No?
So only restrictions with respect to utilization of their profits would probably be when they pay salary to the director. That would probably be the only thing which Section 25 company, that is not in NBFC, microfinance business. Generally, companies have provisions, or rather the secretarial governance requires that when we pay the salary to directors, we need to ensure that they are executive, they have worked for the company, they are actually employed. And otherwise, it's only going to be situation. Other than that, salary, expenses, asset acquisition, all that is permitted, so long as it's for the development of society.
Is any return got to be submitted for the purpose of your investing the foundation, whatever profit you earn? Is it no need to?
Your answer is RBI.
No, because Section 25, when you say how the RBI will control, need not control on a daily basis, but over a period of time, what is the control RBI will exercise on the amount being spent by Section 25. But there should be periodical return from Section 25 to RBI, that is also not okay. That is not mandatory.
No, RBI is not accepted. So the Section 25 company goes and submits its balance sheet. RBI is very important. Section 25 companies do have to file their balance sheet and financials with NBFC.
Just to mention for Section 25, Section 25 company based on what are the NBFCs. Is there any other way that the Section 25 can become an NBFC? For instance, can an NBFC buy out a Section 25 business and incorporate it into its in terms of merger? Are there M&As between NBFCs and Section 25?
Requirement that both companies have and RBI pays that whatever income comes need to be used for the development of the society. Now, as far as portfolio or assets are concerned, the Section 25 company, if it feels necessary for development of society or carrying on a business, it can purchase. If it feels that it does not require that particular asset to go on with the business, it can be business. There's no restriction on that.
So, for instance, an NBFC MFI can buy out a Section 25 company using in microfinance, because essentially the business is at scale. And then an NBFC who is not an NBFC MFI but engages in microfinance practices of limits can then also buy out a Section 25.
So RBI has no restriction on that. So the only thing is the NBFC needs to mention or to make prior indication to RBI that such a transaction is being done, and also give business plan, give prospects in 5 years, give a detailed reason as to why it's doing that particular transaction, and also mention that the Section 25 company's profits or any return of service would not be transferred by virtue of this transaction. What would they be used for? So, if the Section 25 company continues, it can be used for the benefit of the society. If the Section 25 company is wound up, it would have to be transferred to another business or another cooperative society involved in that business. So, it has to be used for the benefit of the society.
So can't this be intelligently done wherein Wherein I purchase it at a loss and then there is no money left in section 25. NBFC is still taking over.
So the section 25 books has shown a lot, clearly computed. You have earned the respective income, gross income, but after putting your expenses, you're clearly getting a loss, then you can transfer it at a loss. So by transferring assets, showing them at a loss, anyway fixed assets you can't do that. Fixed assets you will apply the depreciation as per income tax and then you will do. The only thing you can do this is portfolio. And if the books of portfolio show that this much income, but this much of expense show this much of loss, it means that anyway that amount could not have been used for a particular company for society in future. So the ultimate, what both RBI sees, what company tax sees, and what is generally in practice also, is the fact that any income that is, any profits that this section 25 company has made should not be earned. So should not be distributed. So, like you said, there is a chance. So RBI will scrutinize that. They will see, are you showing the actual numbers? Is there any this would mean that they will even go underground. They will check what actual transactions are happening. They will scrutinize previous year balance sheet of the section 25 company, even though they didn't have to, and then they would approve it. So once it's approved, then
other things like income tax also related, there is a income tax department that also affected. It also has exemptions in the and the income tax. So those exemptions, if the section 25 is trying to use the exemption for other things, you have for the negative. There are negative activities. It's not only RBI.
So in any case, there is got to be a clear there. So in that, since there are so many other statutory authorities, naturally, unless they permit, this type of transaction is not. One is that section 25 making profit, merging them with the NBFC, that means you are just taking indirectly the entire profit of the NBFC. There is a control. Just because there is a loss, if some NBFC they are going to take up that, they can amortize the loss over a period of time. That will be beneficial for the company to reduce the payment of some sort of tax purposes. That is also possible. They can take even loss making section 25 also. So what is your overall? What is your view that this NBFC? Which one is? So NBFC is only for commercial purpose. Section 25 is for promoting art, science, geography, all that.
So any particular reason why NBFC is not allowed to distribute?
as more operational, so NBFC also has the bank also has which means there is open. Section 25 is not a profit.
So what are the benefits? What the loss is not allowing NBFC into the business space.
So if an NBFC wants to
more regulated than
why does a bank engage any other entity to do DP business? Because the bank can't reach out to this business. But if it's an NBFC, there's no restriction in the amount of loans that they can give or the amount that they can give for the dwelling unit. And the NBFC also will not hesitate because they can charge. But if a NBFC wants to give loans to a place where the bank does not exist, where the NBFC is present in the what difference would it make for the NBFC to do that by themselves rather than being a DP to that?
why is it
Section 25 predominantly we were born not to do this particular business. They have other things also. So to do other things also. So that is covering them. I understand when you say when they are into microfinance, why are they?
NBFC purely non-banking. once it gets into those models already actively itself is good. So this is kind of the perspective of RDA again.
I mean, that's correct, but I just want to know the logic behind it. Mostly it's just a basic. You don't have to put it logic, you just have to use your thinking stuff. Where banks can be. So what's the logic behind not asking a question to the agent but asking another person to the agent? You just have to handle the network, you just have to handle the linkage over that space. So user can have
When there is a conflict, so when there is a conflict, when there is another situation where both of us are there, I as an NBFC is acting as an agent to a bank. Would put my interest first. Maybe I collect my money first and then let me. When there is only 100
what is
rupees.
the time that significant amount?
I understand that. But then section 25 main purpose is not only this what we both are doing, like financing. Assume. I understand. I am getting the argument that they say that section 25 which are doing financing are also permitted.
The profit in business norms, this because both NBFC and Section 5 bring the profit. Yeah, you have to that's the profit you can have it. So both the profit. And the Section 5 can go for a profitable business. Point is that you can't get the profit by itself. They have to profit. They have to go for the same profit.
But then nature of business.
Sometimes one day.
That's a statement. What is the logic? I mean, I didn't find a strong reason that might be a very strong reason, but that is it didn't find it. In my opinion, you will not be able to see. Why it is more regulated, strictly regulated language.
And in terms of banks themselves, when the bank was looking for the basic partner, they themselves are not interested in getting the NBFC. Society has not. No. Why I am telling this? Because they were quoting.
I said regulation direction.
Okay.
You can go
push someone out to
regulation direction. Just want to know the logic behind it, why the direction and going into this.
Very logic is again conflict, and then maybe they want to get into a midway path. I don't know.
I think the answer lies in the main, non-banking financial company, like Prathibha pointed out. So if you are doing an NBFC business, see, as of now, we are comparing the regulation with the Section 25 company and NBFC. But if you compare the regulation in comparison to a bank, NBFC is much less regulated. So if you are doing a non-banking financial company, which is similar to a banking work, and then you are becoming a correspondent, a BC of a bank, and practically doing the same work as the bank is doing, it defeats the whole purpose.
Wonderful. Yeah, because they have better expertise in terms of case technology. It's just that they have penetration that the banks may not be able to have. So they may be able to conduct the business better and more efficiently than a Section 25. So essentially what we're saying, the match may be better. So when you acquire or merge with another company, you see a match. So in a BC, you would imagine that working with an NBFC would be far easier, so they understand your business. There is the same line, whereas the Section 25 may not be able to conduct the business with the same amount of professionalism.
Right. So that is completely from an operational perspective. If you look at it from a regulatory perspective, that is where the RBI is coming from. From operationally and practically speaking, yes, what you're saying is perfectly right. But if it's regulatory, if you look at it from that perspective, I think
maybe it's completely illogical like the record. No one knows how the record is ever said. The bank is just a number that they will value the price and that's how the other use the simply try to use. No one knows how that works. There's no set formula to set that.
Market is playing, someone is playing, someone is playing. But they must have
You would hope so. But if you see the historical thing and if you read up on it, there's no trend.